All right. Well, Happy New Year. I'm excited to be here. We're kicking off 2026, new freight market data. I mean, it's not really new. We're talking about December 2025 data, but excited about all the forecasts, all the things that are ahead of us in 2026 to look back to 2025. So I'm here with Steve Beda, as always, EVP at Trax Tech, to kind of unpack all the learnings from an interesting end of year. And as we've emerged into the new year, it continues to be interesting. Even the last 24 hours have been interesting. So lots to
Yeah,
unpack, lots to talk about. So welcome, Steve. I'm excited to be here.
thanks, Joy, and Happy New Year to everyone. Hope everyone had a good holiday. Glad to be here to talk about what we learned in 25 and what we can think about going into 26. But maybe before we start, just real quick, Steve Beda, Executive Vice President, Customer Engagement and Advisory for Trax Tech. My main objective is to work with our customers in improving their programs, helping them understand the market conditions and how Trask can support them in navigating, as we talked about earlier in the year, the murky waters of 25, and certainly how to best plan for dealing with the issues going into 26. So happy to be here, Joy.
Yeah, I'm excited. All right. This is definitely going to be a fascinating time because we ended the year in a unique spot. We started the year in a unique spot. Geopolitics are in a unique spot. We're definitely experiencing all kinds of volatility. What is it you always say that you expect the unexpected? Or
Expect the unexpected, and that probably will continue into 26 as several initiatives. Some of the things we qualified as predictions may or may not manifest themselves, and of course, we don't always know what happens in the like you said in the last week. We heard about some potential tariff conditions that could result that now has maybe gone by the wayside. But the point of all that is you never know what's going to happen next. So you got to prepare for all conditions and all situations as you navigate through certainly supply chain logistics.
well, we're eager to have you here because you know more than we do. So you can tell us how to read the tea leaves, right? All right, so let's kind of start off with LMI. Just for context to everybody who's new to the Freight Market Report, Trax Tech puts this together every single month. We put together a really comprehensive report of kind of all of the data points around things that would be relevant to anyone who's leading in supply chain, right? So all the data that for making great decisions and ensuring that you understand kind of the trends that are happening, the norms that are happening, the norms that are being broken, all of that, and then Steve Beda gives his commentary on it so that you can kind of make good strategic decisions and have the right insights. So let's kind of start off with this, the plot twist nobody saw coming. LMI is always a good context set for us in terms of just giving us a lay of the land and what the trends are looking like and some of those numbers. So freight recession is over. Is that, I think there should be a question mark at the end of that. So, but we are in a very unique spot. So December delivered the tightest market in 3+ years. Transportation capacity collapsed 13.1 points. We had a freight inversion. So yeah, Steve, give us the breakdown of what is happening here and what you think it means.
Sure. Well, the LMI is a composite index. So remember, you have, just like any other KPI, there are influencers on the KPI. Some which could be positively influencing a number and others negatively influencing a number. That's sort of if you think about it in transportation logistics, and you use common KPIs like cost per unit weight or cost per shipment, things like that, there are multiple influencers of those numbers, some contributing positively, some negatively, resulting in a change. So using data to sort of understand what's happening is really important, but also in peeling the onion back a bit and understanding what are influencing those things. So we had a unique situation with LMI where inventory and warehousing constraints were accelerated and exaggerated due to early tariffs coming in 25. There was a anticipation, a bit of unknown going in also around capacity in the transportation market. So early on, there were more flexibility due to that excess inventory. While the inventory costs were up, the transportation aspect of it was countering that overall score. What we didn't know is going into the end of year was how the holiday season would come out for seasonal buying. and also what that excess capacity, whether that was really excess or just a false indicator going into the season. So remember, again, the LMI is influenced by inventory, warehousing, and transportation. And then they're also influenced by pricing and capacity relative to those measurements. So what we saw happen is the inventory burn down that occurred toward the end of the year, which was a buildup early on of forward buying. It did occur, and that reduced inventory on hand, and it also freed up warehouse spacing. So that took a huge dip in the latter part of 25. At the same time, capacity constraints came in as that inventory moved outward toward customers, and it created a capacity constraint along with some price increases that we saw both in the contract and spot markets. So those two things blend together resulted in, you see a downward slope of the LMI there. But again, inventory reduction and warehousing capacity outpaced the transportation side of it, creating an overall negative impact or a lower score on the LMI. So that's kind of a read of it. Again, everyone knew or hoped that inventory would burn off, consumers would come through and buy the right inventory that was staged upstream, and that did happen for the most part. But we didn't know on the capacity side what was going to happen. And so the messaging coming out maybe late Q3, early Q4 is let's not get too comfortable with the transportation numbers, because we could find ourselves in a bit of a capacity crunch as the end of the year downstream last mile sort of movement took place. So the other difference I would comment on this, Joy, is when there was a lot of inventory, there was some consolidation of transportation at lower cost, longer transit times that were baked into some of that because the inventory was on hand. But moving it downstream at the end, those kind of factors don't play in as much, meaning I got to move it when I move it, or because the customer needs it. And so in the end, you can't take advantage of longer transit times, especially during holiday season. So that created that capacity crunch in the end. So an interesting play out of what occurred in 25, and we'll talk a little bit more later on about 26. But we'll see if this curve continues down or flattens out in a more balanced state, which I'm hoping happens here in 26.
Yeah. Okay. That was a good summary. That was well said. I think we do want to dive a little bit deeper into the inventory dynamics, because I think, last year, so much of what we talked about was tariffs, because there were a lot of reactions to tariffs and fear about tariffs. And there was all the kind of warehousing and, like you said, forward buying and dynamics like that occurred. So as the LMI came out and there was kind of this historic lows in inventory levels, like you just talked about, the retail gamble paid off, but like you had said, who knows what's going to happen in 2026. So we certainly don't want to consider that precedent setting. Does the lean playbook work? Will it work this year? I'm just curious to know a little bit how you interpret the data, and then how you would advise maybe supply chain leaders to interpret their own data.
Well, the balance between inventory and transportation is nothing new in supply chain, right? It's a mathematical equation that is influenced by the cost relativeness of those two factors, along with good forecasting and predictions of the use of the inventory. These decisions are not easily made on the fly. They're strategies that bake into these plans. There's no doubt that the cost of that inventory storage and the cost of holding the inventory hit the budget forecasting that was originally taking place in 25 early on. So that didn't help the equation by any means. The result of that inevitably was a higher cost of warehousing, a higher cost of inventory, managing that larger inventory. It did help on the transportation side. The real answer here is you want to balance those two things, right? The best in class, the best case scenario is a balance. But to get the balance, it's really hard to do when you have disruptions. Okay, so I think we're moving back to a more balanced strategy here, which is a more traditional strategy. I think that lessons learned from 25 and lessons learned from COVID way back in a few years back, you also have risk associated with lean inventory strategies, right? So just in time works when everything's flowing well. It doesn't work so well when there's disruptions. So I think there's going to be more of a balanced strategy going forward in 26, less any major disruptions, that allow companies to sort of navigate in the middle, right? Where you're not overstocking, but you're not also using maybe just in time unless it's appropriate. The big overlay on all this in the future will be how much nearshoring and localization of manufacturing occurs. That does take a bit of the transit time out of, well, it takes a lot of transit time and cost out of that. It does make the inventory strategy more nimble and creates a lot of goodness, but that takes a lot of investment and strategy. And there's no doubt the administration is pushing for those concepts in many of the industries that are impacted by inbound shipping from China or Asia Pacific and the other areas of the world. So again, going in a balanced strategy would be the best case scenario and recommended. But how that plays out, we'll see, right? That's a qualified strategy, right?
Well, and I think one of the things that you've pointed out consistently through webinars and reports last year was just the amount of agility that's needed has changed, right? Even for large enterprise organizations, we got to change faster. We got to respond to what the data is telling us, and the disruptions increase, so we have to respond accordingly. And
that's 100%, Joy. We're living in a world where we can forecast. We still need to forecast, but we also have to plan for disruptions and changes, and that takes the tech enablement and the data that is required to make those decisions in very short order and react accordingly. So the sort of forgiveness factor in all these equations is tighter, and you have to be really good at maneuvering through these things and how to react. And without good data, without good information that's relatively recent, and without the tooling and technology to be able to integrate those decisions into the management layer of a company, it's just really critical. You can't survive without that capability in today's market. So certainly most companies I work with are investing in AI and digital transformation roadmaps, and there's a reason, and they understand this concept. So that will be a big drive in 26.
And I think a big part of that investment imperative is the visibility. So if we talk about one area of visibility that we didn't have on the last time we sat down together, right? It was knowing what the holiday retail season was going to be like, right? We've got the indices, right? We know consumer sentiment, and we've got some things like that, but it was actually surprising, right? Where we kind of ended up and the amount of spending that we saw happen and how successful actually the holiday season was. So unpack that for me a little bit. How we saw people spend, how we're watching maybe it play out economically, consumer sentiment, and how retailers are responding.
Well, if we, I know we're showing a different graph here, but there's also, of course, the consumer price index and consumer sentiment measurement. Those were actually, and continue to be fairly much lower year over year. So there was a bit of concern going into the holiday season that it wouldn't be as good as it came out to be. Actually, the numbers show that we had a pretty strong Q4 in that area. There's still a bifurcation, though, of the type of buyers and who's actually enjoying the goodness of where they sit, whether you're in the top demographic income or in the lower. That puts a lot of pressure on the industry, various industries, retailers and others, in terms of what products to store and inventory and plan for, but also the discounts and the relative marketing strategies of how to get that product to the consumer. We talked, Joy, last time about the transformation of the different types of strategies of marketing and buying that are impacting retailers, meaning affiliated marketing, social media, having inventory planning is changed a lot. So that bifurcation in the economy and the consumer confidence index is something to watch. So what happened is we had a pretty good Q4. That means that the right inventory was burned down, if you will, and sold off as a result of the holiday season. Consumers may have used debt to do that, which we know. We have numbers to prove that. That's a kick the can down the road type of strategy. We'll see how that impacts us in 26, but it's something to watch. And I think my message on all of this is for shippers and supply chain support organizations, for marketing and merchandisers. You got to have the right product at the right place at the right time. That hasn't changed. But it's gotten a little more complex when buyers are a little bit more conservative and choosing where they shop, what they shop for, the deals that they're seeing. So that makes it a little bit hard for forecasting and planning. And again, I think that you can argue that the good data, good forecasting, good demand forecasting is probably never been more important in this type of economy until things level out a little bit more between the higher earners and the lower earners, and certainly the majority, which fall in the middle class. So it's certainly harder. Some of the confidence index that you see there in the graph being lower is a perception. And the perception is driven by the cost of groceries and things like that. We know fuel is a good bright spot for 25. It doesn't look like that's going to change. So energy policy is helping improve, but I think we need to see more from the Fed. We need to see more wage increases, broadly speaking, and a general confidence in stabilization, so that consumers feel like they can both non-discretionary and discretionary spend their dollars to keep the GDP and the growth where we want it to be going into 26.
Yeah, that makes great sense. So let's talk about the other side of the coin a little bit as we consider, demand forecasting. Obviously, that's going to affect supply, capacity, all the things that, these companies are having to plan for in advance. As we look back, right, which is what we're kind of doing in a lot of this data, looking back to the last quarter of the year and especially the last month of last year. Let's talk a little bit about the things that did strangle or limit supply, and whether or not those things are carrying over or should be, kind of factored in our considerations as we look into the new year. Obviously, some of these are not relevant for all seasons, but I think it's important to consider the multifactorial dimensions, right, that these companies face when they're making these decisions and the facts that affect. So let's kind of talk through these.
Well, again, I think this was the one factor that we didn't know coming into early Q4, and that was, is the excess capacity going to persist? And it didn't. Mm-hmm. There were people that forecasted that. We talked about the risk of getting too comfortable with that going into holiday, and sure enough, it played out in the numbers. These contributors, some of them will persist. Some of them are situational. We're heading into a weekend with a major ice storm, so that could infect millions of people and things like that. But let's talk about the ones that will probably persist. Mm-hmm. The CDL enforcement is going to continue. There's no doubt with the current administration that there's a tightening of regulatory requirements for CDL. That is inevitably going to create constraints in driver availability and qualification. Not that you can argue the goodness or badness about that, but we're here to just talk about the facts. So the fact is that's going to be a headwind, probably going into 26. It can be mitigated by hiring strategies and things, but it has a sort of a immediate impact on the availability of drivers and the constraints related to that. I think also we saw earlier, and I think we talked about this maybe mid-year to Q3, that carriers we saw some numbers where carriers weren't investing as much in their assets, trucks, trailers, and equipment. That was an early indication that the carriers are being very cautious about their investments. And when they do that, that obviously is a way to drive up pricing, which we also saw in Q4 and we'll probably see in Q1. That doesn't seem to me is something will change. The fact is, I read a recent article where the inflation rate outpaced the ability for carriers to increase their pricing. So if you think about that at an economic level in a business profitability, that means they're falling behind in keeping up with inflation. So that erodes the profits. So listen, I'm not going to sit here and say that justifies a price increase, but I'm just giving you the facts and our viewers. So we can probably predict that carriers that are primarily asset carriers, but even non-asset, will be leveraging this capacity constraint to increase prices until we get to more of a balanced state. Now, eventually this ebbs and flows. Carriers also want the business, so they're not going to want to forego business by the fact they don't have the capability or capacity to manage it. So it's a bit of an ebb and flow. The best case in this scenario would be it becomes more balanced. Okay, so the capacity is predictable, the pricing is stabilized, and we'll have to see how that carries out. But I think those two things will persist in 2026. I think the weather and other things, we can't predict. So they'll come and go as we proceed through 26. But those two things I think will be something to monitor going forward.
I'm ashamed of you. You can't predict the weather. Come on, man.
If I wish I would have bought a generator by now, knowing that I may be without power this weekend.
It's going to be brutal. Yeah, it is. A lot of snow in a lot of places that don't usually get it.
Well, we're going to get ice, so it's even that's the worst thing. I'd rather have snow than ice.
Yeah. It'll be interesting to see how everybody fares. We hope everybody stays safe.
Hope the best for everyone.
Yeah, absolutely. All right. Well, let's talk a little bit about something we've talked about a lot, but we can't ever not talk about because it continues to persistently impact a lot of our decision making and the way that supply chain is operating and costs and all of that. So the China tariff wildcard, it's not just China. Obviously there's a lot of other countries involved, but the dynamics that are continuing to occur and how that's affecting the things that come in and go out and how decisions get made. So yeah, kind of unpack this for us a little bit. And as we move into the new year, I mean, I know last year it felt like a collective breath holding at times, right? Where we were kind of waiting for the other shoe to drop and decisions to be made. And, it seems like some more decisions have been made. Obviously, some still haven't. And yeah, how do we foresee this shaking out? Where are we at now?
Well, I think the things to think about from a tariff perspective, and the graph illustrates this, is really there's short-term pain and long-term gain concepts here. Now we tend to be a very impatient culture, and so short-term pain doesn't go well with anyone, including myself. Nobody wants to pay more for a product, and certainly the factors that go into the dynamics of who pays for those tariffs is an ongoing sort of challenge for retailers and manufacturers. But the point is the short-term pain was the disruptive nature of the use of those on the supply chain. It'd be different if we could plan and knew about it months ahead and everything was all planned out. Well, that didn't happen that way. So it became a disruptor. Long term, the obvious objective here is to balance the trade deficit out. And that results in bringing more products to the U.S. for manufacturing or their location of origin for shortening the transit time and lowering the transportation costs and increasing, obviously, the job in the labor market by producing those jobs in region or in the U.S. in the case of the tariffs. That's the long-term gain. So getting through the short-term pain is not fun, but the long-term game is there. I think better planning and forecasting on these things would sort of mitigate those. But I have no way of predicting what's going to happen, nor can you, Joy, nor can anyone. So I think it comes back to we all don't know exactly what's going to happen here, but I do think that hopefully we're past some of the major disruptions. Hopefully things will balance out here a little bit more and come to an equilibrium. And as nearshoring is taking place, that's the long-term strategy, and that will also play into the sort of hopeful goodness that comes out of all these strategies that are being employed. There's also some political and Department of Justice influences on all this going on, and so nobody knows how that's going to go either. So we'll see. But yeah, it was a very disruptive 25. You can see in the charts, we all know what happened there. It's really going to be short-term sort of pain and long-term gain, and how we navigate through that's important. Be ready, be prepared, and that ought to. And there's just no downside to that, because we don't really know how that's going to play out long-term. Okay.
Yeah, I guess that's the final word on that. So Greenland, where are we at?
Well, yeah, Greenland. The interesting thing about Greenland is nobody's sourcing from there, but it does sound like it's a security concern for everyone. So, yeah, it's. I think again, one thing you can know is you read the news every day, and there's another twist in the plot. So, it's be prepared, right?
But the 25% tariffs on the EU are not happening. As of
today? As of right now, the threat of the 25% tariff is no longer there. The markets negatively reacted to the scare tactic, and then they positively reacted to their worked out a framework, I guess, in Davos. So that's good.
There you go.
I think I failed to mention one other thing on the economy too on the previous slide while I'm thinking about it, and that is economic policy may change in 26 with some new with a new board and a new head of the board and the chair. So we know that's going to happen. It's not a question of whether it will happen. The question is when will they be able to invoke what I believe them to be more dovish strategies in economic policy, which should be goodness for all of us in 26.
Well put. Okay. All right. And then let's go ahead and kind of look ahead now. So thanks for all the intel. I think that was super helpful. We've got a lot of good thoughts now as far as look back and where we're at with trend reports and things like that. I think it's helpful now if we can kind of unpack some of the insights that you've given us, and these are all from you, obviously, to look at 2026 planning and the things that are top of mind for you and that you think should be top of mind for people leading out in supply chain. So walk us through.
Well, let's recap with the first point, which I talked about, and that is we saw the inventory divergence. We see that my prediction is we'll move to a more balanced state. But this is a difficult equation. It always has been. And I think that what the lessons learned from the past, as I mentioned earlier, and the lessons learned in 25 are being able to balance this equation between too lean and too rich on the inventory side, and which also impacts the warehousing side of things. But we know there's a cost associated with it. If everybody had their wish, it would be all lean, but that's not a reality state. So the key here would be, again, proper planning, proper balance, and good data, making good decisions and forecasting, and monitoring closely the demand from the consumer and what they're willing to pay for, how they're thinking about spending their dollar. It's becoming more challenging to do this for all the reasons we talked about. And so I think that the folks involved in this in the various industries and the companies have to be really good at it, probably better than they have in the past. Okay.
Makes sense. All right.
The second, you just wanted to walk through each one?
Yeah, let's just dive in now to the inventory divergence. I know you kind of spoke to this.
Yeah, the second one, I kind of covered both points.
Right.
So yeah, I probably skipped a point. So I'll probably go back and do point one first. So really, capacity will stay tight. Yeah, we talked about that. So I think those headwinds will continue in 26. I do see it becoming a little bit more balanced, but it does ebb and flow. Right now, we're in the condition of tighter capacity, price increases. That kind of plays into the third bullet there while we're on it. And that is, it's always it's kind of like predicting the market. That's really hard to do, right? If we could, we'd all be pretty wealthy. But certainly for procurement organizations trying to get ahead of a price increase or take the goodness out of a predicted future increase, locking in the contracts are really important. Sometimes you win on that. Sometimes it doesn't work out as well as you like. But as of right now, we see price increases. So I have no indicator that says that that's not going to continue to happen going into 26.
Okay. That's good. What about lead times?
So lead times is an interesting thing. We talked about that before. That's, again, controlled by inventory, where inventory is placed, and good planning. I think that, again, what happened in 25 is with the excess inventory, longer lead times were an option that did help alleviate or mitigate some of the cost increases on inventory and warehousing. But there's probably going to be a balance there coming into 26. So I think good data, good planning, and I think also dealing with the transformation of the marketing side of product, the digital transformation and availability of product for consumers when they need it will make this harder. I think for companies to forecast and plan their inventory and where it should be. But again, on the upstream side, longer lead times based on inventory. On the leaner side, less transit time, all influences those transportation costs. So given that we don't know what's going to happen, it'll probably be somewhere in the middle, right? Somewhere balanced, but be prepared for either case, if it comes about in 26. The next bullet is really the X factor. So we don't know. Like I mentioned earlier, I believe that everything is being done to create less bifurcation in the economy, in the K-shaped economy. I believe the administration is doing things to improve this situation, which overall will improve consumer sentiment going into 26. But that's a qualified answer. We don't know exactly. That would take new Fed policy. That would take continued tax relief. That would take fixing some of the healthcare issues that we're facing, wage normalization, bringing more labor, because labor is another factor, right, with inflation versus labor and unemployment. So there's a lot of factors going into this, but I do think that everything I see now tells me that we're willing to react more appropriately, we as a country, and not sit on numbers and hope that things happen. I think you'll see a little bit more aggressiveness around getting to the objectives that we need to meet, versus sort of being a little bit more conservative and waiting to see what happens. That's a qualified prediction from me, but that's what I see. This is a known factor. It impacts politics and electability. And so I see a strong push in this area to improve in 26. Yeah. And then the last, I don't see any sort of recessionary concerns. I don't see a freight recession coming. I do see a capacity constraint that will balance out long term with the things we already talked about. So plan accordingly, be agile, use data to your advantage, and integrate the data and decision making into your operational metrics and management layers to be able to perform in a market that could drastically change on a dime. Could go toward the positive, or could go toward the negative, right? So be ready. I don't see the current administration being the type of do nothing and just sit on current state. And so expect the unexpected. Continue to expect sort of maybe rash policy decisions that impact things us in the short-term pain concept that have long-term gains, and be patient enough to navigate through it.
Yeah.
Okay.
That's great. I appreciate that so much, Steve. That was really succinct. We had a question come in from LinkedIn. Can we get a copy of these charts? That actually segues really well into the summary here. Robert, we have this an entire report that goes out that includes all of the charts that we shared, plus a lot more, called the Freight Market Report. So I'll make sure I drop the link to that and you get it in your inbox, and you can have all this and more. So we'll make sure that you get access to that, and I'll have the link there for everybody else too. We want to make sure that you get this report that we curate together every month in your inbox, and that you also get notified when we do these monthly webinars, so that you can get Steve's insights and his reflections on what happened in the previous month and forecasts into what is likely to occur in the coming months, as you've heard already. So Steve, this was awesome. Thank you so much. I feel like we kicked off the year really well with some great intel and insights. And I know we've got these already scheduled out for every month. So make sure if you're on LinkedIn or YouTube that you sign up for notifications, so that you can get notified when we're going live again for these monthly sessions. But great start. I think it's going to be an interesting year.
I think so. And thanks for hosting today. As always, it's a joy and sharing information out with our broad audience. I continue to see the glass half full. We'll see how it goes.
That's right. All right. Awesome. Everybody have a good rest of your day. We'll see you next month.